apologize a little bit in advance because a lot of the questions are very like basic as fuck, you know?
Yeah,
Because it's
that's
like
fine.
I don't understand anything about finance, so that's kind of the starting point, you know?
Yeah, I understand. And just a disclaimer, I mean, I'm not an expert in everything.
Right.
But I have a pretty wide background, so I'll answer what I can, the best I can.
And also,
And just an official disclaimer, if we're posting this on social media, then I have to say that these are my own personal opinions.
right. So I was about to clarify as well.
And not the opinions of my workplace.
Right, not legal advice or professional advice or anything like that.
Yeah, I'm here purely in a professional sense. Oh,
No.
sorry. In a, in a, how do you say?
Fun sense.
Yeah, I'm
No,
here.
good side.
I'm not here in a professional representation. I'm just here to give my own personal opinions.
For sure. And potentially put some insights into some questions that I have as well. But I thought we could just start with a basic introduction of like who you are, what your background is, what you do, and so forth.
Yeah. So my name is Victor Groot. I am Joyce's brother, and I work in finance. My title is basically just analyst. I work for Nordea now, but I work as what's called an equity desk analyst. So basically my job for Nordea is to help put together their model portfolios for equities. So it's basically the official recommendations that Nordea has towards which equities individuals should own. So if you go into Nordea and say, which stocks should I buy? Then me and the chief analyst, we put together those portfolios. But my background is in finance and accounting. So I have a master's in that, and I'm studying for the CFA, which is the charter in finance. I'm almost done with that as well, hopefully.
Yeah, congrats, man.
Yeah, thanks.
Yeah.
So I have my focus is equities, but I have a pretty wide background, I would say.
Okay, cool. What are the specifics of what you do? Like, is it research? Like, how does your kind of job? What is the tasks of your job entail?
Yeah, it's kind of a hybrid position, you could say, because I sit with what's called the front desk, which is people that are more focused on sales. But I take a lot of the information from the research side, and then I kind of package it into these portfolios for clients, so that sales, they have talking points for clients, which, you know, official recommendations that we have for equities. So it's kind of an analyst and a portfolio management position in one, because if you go in as a customer to Nordea and you say, I want help with my investments, then there's lots of different things that you could buy or invest in. You can invest in stocks and bonds and alternative investments. And so I'm focused on the equity side, which is stocks. So then they say, well, help me put together which stocks I should own. Then you have official recommendations for stocks, and those are the ones that I'm involved in putting together. And the purpose for that is basically to help the advisors and the salespeople in advising clients what they should own. So most of our job is basically researching different stocks and determining which ones we think will outperform.
Do you do that in relation to any specific clients? Like if there's a client that has a certain portfolio, will you research certain stocks that you think will be advantageous for that client? Or is it very generic where it's like you think these stocks are going to increase in price, and so you would hope that all potential clients would invest in these stocks?
Generally, it's a sort of bank-wide solution for all clients. Certain clients, we can help them to put together a portfolio if it's a large enough client. But generally, it's for everyone. So we have 3 portfolios. One which is just purely Danish, which is called the Danish 10, because Denmark is so small and you need large stocks that everyone can trade. You can't pick like this tiny little stock, because the client won't be liquid enough for the clients to actually purchase it. So you need to make sure they're quite big. And in Denmark you have the C25, which is the 25 biggest. It's the index. So you can't have like a too big portfolio. So you pick 10 in Denmark, and then we have the Nordic 20 stocks in the Nordics that we make into a portfolio. And then we have the global 30, which is the 30 ones in the developed world that we think will outperform. So we kind of try and stay neutral in terms of like regions and stuff like that, and sectors. But within the sectors and the regions, we try and find the stocks which will outperform. So ones that will do better than the market expects.
Is there a reason that you would focus on the Danish market and the Scandinavian market as opposed to just the worldwide market? Are there certain advantages to investing in Danish stocks that aren't there if you invest in like Spanish stocks or something?
Yeah, I mean, what kind of drives the portfolios that we have is the client side, what the clients are interested in. And in that sense, I sit in Denmark and we work with a lot of Danish clients, and there's something called the home bias, which is that most clients purchase a larger proportion of stocks in their own country. So they'll ask, a lot of them will ask, what's your official recommendation for Danish stocks? So it's super important that we have a view on that. That's why we have a Danish portfolio. That's not to say that Danish stocks necessarily are more attractive at all times than global stocks. Right now, for example, a lot of the strategists' view is that Danish stocks are very highly priced as compared to other stocks. So American stocks might be more attractive, but it changes all the time, depending on how the market moves. So the global portfolio is one of the few global views that we have in Nordea. We have a lot of Nordea asset management people that are putting together global portfolios as well. But the difference is you have something called discretionary portfolios and then more advised portfolios. And what's the difference? The difference is a discretionary portfolio, that's what most people think of when they think of a portfolio. You just buy it, right? Like you go to a bank and you say, hey, which funds do you have? Or we have this North America one. Okay, I'll invest in that, and then they take care of everything. They change out stocks and everything. They don't need to tell you every time. But in an advised portfolio, then we can just show you and say, well, we have these 30 stocks globally. Some clients can say, just give me those 30 stocks. But others might say, I want this one, this one, this one. And that's the unique concept of something like the Global 30. You can't do that in a in a regular fund. Okay. So,
cool.
Yeah, I hope that answers your question.
Yeah, it's very thorough. I like that. I guess because I really want to understand, because I've been watching a little bit of like how to invest and stuff like that.
Yeah.
I like to think that I have at least a very basic beginner's perspective on it.
Mm.
But when it comes to actually investing, right, and kind of valuing the stocks, I really don't feel like I have any understanding of that. What exactly is it a stock? Like, it's partial ownership in a company, right? If you buy a stock, how exactly are they valued? Is it just supply and demand? So if a lot of people want something, it will increase in value? And how is that calculated? And could you couldn't predict that, right? Like, that wouldn't be possible, because otherwise you could cheat the stock market, right?
Mm. So is your question also what is an equity, or is it more just simply how?
From my understanding, an equity is basically partial ownership in a company, right?
Yeah.
And then you could, for example, sell that if the company increases in value or something. But my question is, how do you determine the value? I guess the first question is, how would you determine the value of a stock? Is it really just supply and demand? So if a lot of people want a particular stock, it will increase in value as well? Or is there something else to it?
Yeah, it's a great question, and it's not one that's always that straightforward to answer, because the stock market is very broad. There's lots of different ways to trade things. But at its very essence, the stock market is based on supply and demand. So if you have these electronic markets where people are simply buying and selling from each other, then you could say, yeah, it's just what are people willing to buy and sell it for, and that makes it the price. But the price that people are trading at in an efficient market, there are different theories on how efficient the market is. When you say efficient, you mean, is it trading at what it's actually worth?
Right.
And so people try and value the company, and then they say, well, the company is worth this and this much, and they have this many stocks. So each stock, value divided by stock, has a price that is the fair price.
Right.
That's what's called the fundamental value, or the justified price. So what a lot of people that are actively purchasing and selling shares do is that then they value stocks on their own. They say, this stock should be worth this much, and it's trading below that. We know that generally stocks trade around their fundamental value, but they fluctuate a bit because of, just day-to-day volumes of trade, or because people might not see the value that you're valuing it at. So if you have high conviction, it's called, you think it's going to actually go back to its fundamental value, then you buy it. And it'll hopefully go up to its fundamental value, and you earn some money. You could also see the opposite. You could value it at a lower price than it's trading at. Then you go into shorting it. It's betting on it goes down, and hopefully it does that, and you earn money. But yeah, so that's sort of the most standard way to think of how do you value a stock. And then you can go into, well, okay, how do you determine fundamental value? And the most basic concept of determining fundamental value for a stock is discounting cash flows. And
so like revenue and profits?
Yeah, depending on the perspective you take, whether you want to buy the whole company or just a simple share of it, then you discount different cash flows. So you can think of there are two returns that you earn in a stock. One is the dividend that they pay you.
Right, because you're a partial owner in the company, you get certain monetary value as a result of which, right?
Yeah, they're earning money every year, hopefully, and then they might not need to keep all of it. So then they say, well, we're paying this out to our shareholders. So you get a small fraction of that, and that's called your dividend. And that's the one source of return that you get. The second source of return that you get is capital appreciation. And that's basically just that the stock price rises. So those are your two sources of return. But so if you're valuing these dividends, for example, right? And then you can say, well, the company might pay a very steady dividend. And you might say, let's say that goes on for infinity. Then this is called a time value of money. The further out in time money goes, the less valuable it becomes, because you'd rather want it now. And certain things like interest rates and inflation mean that money with time decreases in value. But so you take all these infinite dividends, right? This is just a hypothetical scenario, right, but it's a very simple one. You have a big company, pays a dividend, it's stable. Then you say, okay, well, how much is this worth? I know I just want to buy a single stock, so I don't have control. And then the dividend is a good proxy for value, because I can't buy the whole thing and say, give me everything, right? So you can just look at the dividend and be like, that's my realistic return. So you take these infinite dividends, and then you discount it to today. You might say, this is a very basic way of looking at it, but you might say, if I go to the bank, my interest rate on the money that I get is 2%. So that's the rate I want to discount it back to today at. So then you take these infinite cash flows and you discount it at 2%, and you keep increasing the 2% value because it's going further and further out. And then you discount it all back to today, and you get a value of these cash flows. And that's the value that you then look at in terms of number of stocks and everything. And then you say, this is how much it's worth. So that's a very simple way of doing it. It's the most basic way, but not everybody does it like that. There are lots of people that, especially in these days, they look at more just technical indicators. They don't even care how much it's worth. They just look at the stock price and how it's moving. And just
Is that what you would call a day trader? Somebody who looks at that?
yeah,
Yeah.
that's exactly right. Day traders are generally because fundamental shifts, they take maybe 1.5 years sometimes to pan out. But day traders, they sit and trade daily fluctuations.
How do you calculate that? You had a professor, right, who said that that was just hogwash, that doesn't actually work. But surely there are some people who manage to generate quite wealthy or quite good profits on that as well, right? Is there a reasonable way that you could calculate whether or not a stock would fluctuate in a day? Is that because that would be you'd have some sort of inside information, right? There's some sort of information that could potentially determine whether a stock is going to rise or fall, and then you make an investment on the basis of that, and then after which you either sell or you buy the stock, right?
Yeah, so with it's called technical analysis because you're looking at technical indicators, which is related to just the price movements and things like that. You can also look at other sort of trading points, but you're not looking at the fundamental value. You don't care. There might as well not be a company. You're just looking at how the company's equity or whatever is trading. And so there are different theories on whether it pays off or not. And so it's called the efficient market hypothesis. So people, they say in some instances that the market is completely efficient. You can't earn any money on trading these technical indicators. There are different levels of efficiency of the markets though, and I'm not going to sort of go into too much detail about it. But if the market isn't efficient and the stocks don't reflect these technical indicators and this information, then things like behavioral finance that people might freak out too much at certain points because, oh my God, COVID, stock markets drop a lot. This might be unfair in the market sense. And so technical traders, they just look at these indicators all day and they sit and trade and try and time it. And generally, I don't think in a very long career time span you'll earn money on it. But I do think that at times the markets are volatile and it is possible to trade. And it's also, the market is very huge, right? It's a global thing. And certain markets have less financial institutions, less researchers. They're not as efficient. You're looking at some of these emerging markets, and in those markets, there might be more opportunity for technical trading. But there's a small subsegment of it called high frequency trading, which basically I think is one space where you can earn money with pretty much certainty.
Certainty?
Yeah.
So you can actually generate profits 100% of the time? Is that what you're saying?
Pretty much.
Why doesn't everybody do that though?
Well, there are several reasons. First of all, a lot of people do try and do it. First of all, I think it's destructive for financial markets, and I think it's on the verge of fraud. But
how does it work fundamentally? If it's such a high degree of success, surely there must be something fishy going on there, right?
Yeah. So high frequency traders argue that they provide liquidity to markets. So liquidity is basically just trading volume, and it's good because you want lots of liquidity because it helps determine the prices in the most efficient way, usually. But what high frequency traders most of the time are doing is they're front running trades. So you have normal people that are buying and selling stocks, and then these high frequency traders, they set up their operations right by the stock exchanges.
Oh yeah. I think I'm familiar with that a little bit. And then if I maybe let me just make it a guess here, is that if somebody's about to make a trade, they can then predict that in advance and then buy the stocks and then sell it back to those people, or is that incorrect?
No, it's right. So there's different ways of doing high frequency trading, but in the most basic essence of it, then it happens in the milliseconds. It happens faster than your mind can comprehend. But they're seeing the flows come in, and then they have algorithms set up so they can see and that you want to buy the stock. So then they hurry up and they buy it in the market already at the lower price, and they sell it to you for a little bit more. So if you click on your computer buy, all of a sudden you bought it for a little bit more than the price that is set when you were clicking. That's the high frequency trader coming in and skimming off the top. They're buying it in the market when they notice that you want to buy it and sell it to you for just a bit higher price. So you can say that they know this thing is coming in, and that's why it's almost a certain profit, right? Because it happens in the milliseconds. So a lot of these companies that do this, they also, some of them say, that they've never not made a profit.
Wow. There was a newer, because there's a lot of different stock exchanges, right? You got the New York Stock Exchange as well, but you got a lot of other ones. I recall that there was one stock exchange in particular that tried to kind of fix this by having a long, basically a cable of sorts where you make the trade, and then that way it slows down the transaction so that you can't do this high frequency trading that you just discussed.
Yeah, it's a great point. There is ways that you can stop high frequency trading, and it's actually very simple, and they do have certain exchanges that do it.
Why not? Why doesn't everybody do it? It seems to provide a certain sense of stability to the market, right? I guess you said it could potentially provide a certain imbalance if everybody's doing this high frequency trading and trying to make profits off of everybody's transactions.
Yeah, I mean, I'm not an expert on why everyone doesn't do it, and I think there are different reasons, but in general, I think you need to look at the conflicts of interest for the stock exchanges. A lot of the time, the stock exchanges are listed companies, and the high frequency traders are their customers. So they pay the stock exchanges a lot of money to be able to put up their operations right next to the server. And if it's not illegal and they're paying you a lot of money for it, you have a pretty decent incentive to keep it going.
Right.
But it's not good for the markets because it makes people lose trust. But you can do stuff like randomizing times of trade and slowing down trades.
Yeah.
And that basically ruins the operation for high frequency traders, because all of a sudden they don't know, this might be a big trade and we're front running it, but they might randomize slowing us down, and all of a sudden we take a huge hit. So it would completely destroy the business model for high frequency traders.
There was a company that I heard about a ways back, but because a lot of companies they want to, as you said, do this high frequency trading thing, or at least they want to have it so that their transactions are as quick as possible, so that the high frequency traders can make a profit off of their transactions, right? But from my recollection, there was another company as well who realized that they didn't necessarily have to increase the speeds of the transaction, but instead could slow them down somehow, which also messes with the high frequency trading. And that was supposedly worth, according to the guy who started the company, hundreds of millions of dollars, because that's what he could reasonably kind of save them in costs from trading. Are you familiar with that at all? Is that anything?
I'm not familiar with someone doing
the reverse of high frequency trading, essentially.
I mean, I'm familiar with the concept of exchanges doing it on sort of a trade-wide basis, and that might be what they're talking about. But I'm not aware of someone selling that unique solution to companies that trade. Right. To say, well, we'll slow down your trades a lot. Also, because it's a two-sided coin. Because companies do want to trade quickly, because markets are volatile,
right.
And it's called execution risk. When the time from you decide you want to trade and then you actually get your trade through, that the price changes a lot. So it's not attractive for you to sell something to the company that'd be like, well, now it's going to take you an hour from you click and then you get it through, because it might be that millisecond profit skimming is gone. But it might totally move in the wrong direction. Your trade might tank, So from that perspective, it's a weighting of it, and that's why it's probably something that the exchanges themselves need to do a holistic solution for. It's not something that you can just, you can try and speed it up so that it's faster than the high frequency traders, but good luck with that. They're right next to the exchanges. They use the most efficient types of glass to transfer the information. You're talking fractions of milliseconds here, and I don't think anyone's gonna outspeed them. So I think it's something that the regulators need to look at.
I wanted to ask you about something in relation to your advice about investing. I talked to you recently about a friend whose scheme for investing was he invested in companies. We talked about this where they can't go public, so they merge with another company, and then through that they then manage to go public and can sell stocks, right?
Yeah.
He invests in that, and supposedly he generates 3 times the amount of money that he invested back into it, right?
Yeah.
I think that's very appealing, and then I asked you about it. You had a little bit of criticism towards it naturally. But my question is, because you talked a little about high frequency trading, I don't think that's something that everybody can engage in, right? That's something that requires a lot of capital to get started. You need a headquarters or something close to a stock exchange where you can then invest through that. So is there any reasonable way to is there a get rich quick scheme for stock exchange, or would you recommend that you take this long approach where, as you said, you look at you try to analyze what the company's worth, you try to see if they're undervalued, and then you buy stocks in relation to that?
Yeah. So for high frequency trading, for sure, you need a lot of capital to get started. I heard that one, and you need a lot of expertise as well. I heard that there was one that actually got listed in the States. So I think that you can actually buy into one of them. I'm not sure if it's a good sign that they're listing almost. But if there is a get-rich-quick scheme, no, there's not. There's lots of people that target certain individuals that aren't that financially astute. And with get-rich-quick schemes, it's a big thing online that people get spammed with. Invest with us and you'll get guaranteed returns. It's actually it's on the borderline, or almost always it's fraud.
That is fraud.
There is no get rich quick scheme. People that try and engage in it lose money most of the time. People that trade generally daily, you're most of the time paying more fees than you're earning in return. So no, don't try and out trick the market. Generally, if people go in and do that as a normal individual, you're the dumb money in the market, and others are going to be profiting off of you. So the best thing to do is if you're not a professional, is to try and basically earn the best risk-adjusted return. So, if you believe in active management, then you can pick an active fund. Otherwise, if you don't believe in active management but just want to follow an index, then a lot of options for that. But
you said a risk-adjusted investment?
Yeah, so you talk about... So it's important to mention that luck actually plays a huge part in the market for lots of people, And if you get rich by luck, who cares, right? You're still rich. But it's not a strategy. This the whole hope is not a strategy, right? You can't just buy loads of penny stocks and be like, please, you're probably gonna lose money on it. So the concept is, the best thing you can do is just be smart with your money, And a big concept in finance is risk-adjusted returns. So you want to earn the most money you can with the least amount of risk, right? If someone says to you, you can earn $100 with certainty, or $100 with 10% chance, of course you want to take the certainty, right? It's actually a bad example because of the math behind it, but the concept is that's the concept. So the best thing a normal investor can do is basically just spread out their risk. In finance, there's a concept of systematic and unsystematic risk. So I'm going to just describe it very quickly, but systematic risk, that's just the risk of investing in the market. The market moves up and down. That's systematic risk. Unsystematic risk, that's I take all my money and I invest in this one company. And that one company has loads of risk factors that aren't related to the market. Then all of a sudden they find out that there's fraud involved, or the big CEO, he quits and he was a huge part of the company and the stock tanks. That's called unsystematic risk. And the market isn't gonna reward you for taking unsystematic risk.
Unless the element of luck plays a part, which you also said isn't a reasonable strategy.
That's almost not you getting rewarded. That's just luck happening. I mean, no one's actually rewarding you. It's just something happened that wasn't expected, and wow, But it's true, actually, what you're saying, that the skew of returns is more geared toward the extreme with these small investments, right? There's a bigger chance that this tiny stock booms to an obscene value than the entire stock market does.
Right.
So it's called the right tail because it's the profit. There's a more extreme right tail. But if you look at the median right tail, the median excess return, that should be better in a spread out risk. You want to take the risk that you're rewarded for, and you're rewarded for the market spread out risk. That's why everyone's saying diversify. So as a private individual, don't try and be smarter than the market, because you're not. Don't try and get rich quick. But if you can earn 4 or 5% a year for, let's say you're in your mid-20s, for 40 years, if you invest every month and you earn 4 or 5% on that, and you earn it every year, you're not going to earn it every year, but let's say you do it on average, you're going to get wealthy. You're going to have the money that you need. And it's a privilege to be able to save. Most people can't do that. Most people aren't able to. But people get greedy. They think it's boring to earn 4 or 5%. They think, I'm never going to get rich this way. But the compound interest actually is huge.
So it's like exponential profits in a sense, because you're earning 5%, then you put the 5% back in, and then it gets bigger.
Yeah, it's compounding.
Right.
All of a sudden, you're earning more money from the interest that's been compounding than what you're paying in. And that's the get rich quick scheme, or that's the easily getting rich, because that's the whole trick. There's nothing more to it. It's simple, but it's the best way to do it. It's the way with the best odds. Just continuous investment, be satisfied with a normal good market return.
So if you kind of summarize a little bit, you say don't put all your eggs into one basket, diversify, invest in a lot of different stocks, so that if one goes down, your entire investment isn't ruined in a sense. And then also try to play it smart, so kind of analyze the cost or payback versus the risk. How would you do that as well? Like, how would you reasonably, as somebody who's not at all knowledgeable about that, how would you be able to calculate what your risk versus reward is?
So generally there are different sort of ratios that you can look at, and that's sort of trying to summarize excess risk adjusted returns. The most popular one is called the Sharpe ratio. And so it just takes the expected return, or the return that you have been earning, and it takes away the risk-free rate. It's like what you could earn on a safe bond. And then it divides that by the standard deviation, which is like the most normal way of expressing risk. That's risk. How much is it moving? The volatility. And then the standard deviation is a way of measuring that.
And they can look at that through its history, right? So that's how I would analyze that and try to predict.
Yeah. So you differentiate between ex post and ex ante numbers. So ex post is looking at something in historic terms. Ex ante is looking at something in the future. And ex post is, of course, way easier and way more certain than trying to predict. You have all types of models that can try and predict for different products, but most basic, you just look at the historic volatility, how much has it been earning, and then you can divide the excess return that it earned by how volatile it was, and that's the risk-adjusted return. So hopefully it earned a very good return for the level of risk that it took. That's the simple concept. And there are different ratios that can help you do that, like the Sharpe ratio, the Sortino ratio, the Traynor ratio. There are lots of different ratios. But I think don't try and necessarily predict always, like, oh, I'm going to earn this and this much in the market, because you don't know. And the people that are doing it and guaranteeing it are wrong. No one can guarantee you any return unless it's a bond with fixed payments, you know. So just try and spread out your risk. Try and minimize, the fees that you're paying, and then slowly keep paying it. It's going to be tough for you. You don't know. You're not going to know with certainty how much you're going to have in 20, 40 years. But hopefully you'll have you'll have more than when you put it in your own bank account. You can only use historic returns. That's usually the best we have of what the future is going to bring. So you're not going to have some spaceman come back from the future and say, this is how much you earned on the stocks, man. No one knows, but you can take historic correlations and say usually the stock market for this in this country earned this and this many percent. My 4 or 5% is pretty fair. And then that's the best you can do.
I think this is very interesting. I have a lot of other questions associated with that, but I think because there's some other questions as well that I'd like to ask you about that I think are very interesting, particularly about cryptocurrency as well.
Yeah.
There was back when cryptocurrency was first pulling out, right? There was this kind of news coverage of how the banks are threatened by cryptocurrency and how it can render them obsolete. And at the time, you said that it wasn't really well founded, or you said that it wasn't. It was just hype from the media. Do you still believe that? Do you think that, because the whole idea, or at least partially behind the idea of cryptocurrency, is that you don't need banks, right? You don't need them. They kind of eliminates the middleman of the bank, right?
Yeah.
So wouldn't that render them obsolete? Like if cryptocurrency manages to become the predominantly used currency of the world, surely the banks would suffer as a result of that, right?
Yeah, it's first of all, it's important for me to say that Nordea's stance on cryptocurrencies is basically sort of we're not big fans of it because of some of the abilities to hide the origins of the money. So I can't endorse cryptocurrencies. I can't own them myself. But I think there are many ways to look at financial institutions. There are many different participants in the financial markets. And so now we're talking about banks, right? And how do banks earn money? And there are many different ways that a bank earns money. But the biggest chunk of it is called net interest income. So it's basically the difference between the money, the rate that people are paying on their deposits. So you go and you open a bank account, you put some money in, they maybe pay you a little bit for that. But if you want to loan money, then you have to pay a higher rate.
Right.
So this difference between the loans and the deposits, the liabilities and their assets, they are called net interest income, and they're the biggest source of income usually for banks.
So the idea that you put some money into the bank and they give you a little bit, and then they take your money and they lend it out at a high interest rate.
Yeah.
And they earn some profit off of that. You want to learn a little bit of profit as a result of having your money in the bank, and everybody in a sense is a winner at the end of the day.
Yeah, so that's the concept of the net interest income. So generally, that is probably the biggest area that's under threat, right? Because people don't need to have their money with the banks anymore if the cryptocurrency really does expand in that way, because they're not held at banks, right? They're held at all types of other institutions. So the banks might lose the deposits, they might lose customers. But there's certainly the whole liability side, loaning out, is certainly still something that the bank has an opportunity for, because that's not something that cryptocurrency is facilitating, right? Who's loaning you money in the crypto market? No one. It's your own money. It's your deposit. And so yeah, that side will be under stress, and not just from Bitcoin. There's certain lots of big countries are talking about making their own cryptocurrency. Yeah, it's a big thing. So you might have state-backed cryptocurrencies. It's definitely going to come around, and that's also going to put the banks under duress. But it's important to say, I think the banks will migrate probably to focus on, maybe they'll endorse or bring it in some kind of way, in some shape or form, or they'll focus on other key areas.
You don't think they're gonna, much like the television boom, like they tried to hold on and they weren't able to adjust to the times, and as a result they're kind of like stuck in the past? You don't think banks potentially have the opportunity to kind of falter in the same way, where they're trying to hold on to the profits? Because at the end of the day, that's kind of what the foundation is, right? That they're trying to have as high profits as they can, and if somebody's kind of compromising their bottom line, surely they try to fight that tooth and nail, right?
Yeah, it's also hard. I mean, I'm certainly biased in my workplace, right? But I think you can kind of look at it in the same way as the post office.
Right.
People stopped sending post because they got email, but then people started sending more packages. It migrated and it shaped into something else. And it's important to say that this isn't the only source of banks' income, and banks have different ways they're set up. For some, this is way more important source of income than others, but they also do. You have the whole investment banking arm. Helping companies get listed. You have debt capital markets helping companies issue debt. Or you have the whole investment advice side of things, helping customers manage their money.
Right.
But
you said as well that that's not their largest source of revenue. And it
depends on the bank.
Right. But you don't think that if cryptocurrency severely kind of targeted that area where they no longer have the ability to generate profits by lending out other people's money, you don't think that could potentially lead to some sort of negative consequences, maybe potentially another financial crash of some sort?
That's too broad for me to comment on. But I think the main thing that will be pressured is the deposit side. But I still think the banks, these whole service-wide financial distributions are capable of supporting themselves through other activities. But you have lots of smaller banks that, this might be a really, really significant portion of their revenue. So if I was to, hypothesize in something that's generally not my field, then you could say that it might hurt the smaller banks, it might speed up, concentration in the industry, so you have even more larger banks. That's generally also something that's happening already, because there's so much regulation and so many economies of scale benefits to banks merging. So yeah, it's already happening that lots of these small banks are struggling. So, I definitely think for some of the smaller banks, it might be the final punch for them.
Right.
I think that's possible.
So you don't think that banks should have any reason to be particularly threatened by cryptocurrency unless they're a smaller bank? But if that's the case, why wouldn't Nordea, for example, want to potentially get in on the action? Why are they holding you back as somebody who could potentially own cryptocurrency and saying like, no, you're not allowed to have any part of that?
Yeah, again, it's not an area that I can speak on Nordea's behalf for.
Of course, personal opinion.
Yeah, and even so, it's not something that I can comment on too heftily, because I don't know that much, to be honest, about Nordea's opinion on it. As far as I can remember, it had to do with the fact that we don't support money laundering, we don't support terrorist financing, we don't support illegal use of money. Okay. And with cryptocurrencies, it's a problem that's been identified.
Right.
That you can't always find the source of the money, So it's used for dodgy businesses, and that's as far as I can recall, that's the main reason why we're not allowed to engage in it, and we don't support its use.
Okay, cool. NFTs was something we talked about as well.
Yeah.
I understand that you might not, as somebody who works in a bank, have any particular maybe interest or understanding as to what NFTs are, but maybe I can just summarize it briefly from my understanding at least, right? So NFTs, non-fungible tokens, is basically this way of proving ownership over certain things, and it's basically lended itself to the ability that you can now purchase digital art. And the NFT, non-fungible token, basically proves that the authenticity of the work belongs to whoever buys it. I want to know what your perspective on it as somebody who invests. If that's something that would be taken seriously, if that's something that people within your realm of expertise is at all discussed, or if they're all familiar with it, or if it's something that's being taken seriously.
Yeah, as you said, I'm not an NFT expert, and it's generally not an area that I know that much about. If it's something that's been sort of integrated into financial markets and something that banks are very aware of, I think not. I think people have heard of it, but it's in the same way as crypto. It's not, the financial markets haven't really embraced it. So I think NFTs, in my own personal opinion, is that it's very connected to cryptos, right? I think a lot of people that are buying these obscene amounts of money worth of NFTs probably earned it through crypto, or something like that. They earned a lot of money in a digital sense, and that's their sphere of interest and influence, and so they buy digital paintings or digital art in some form. And so NFTs has been around for quite a few years, but it became huge. I think I haven't tested this, but I think if you look at correlation with the values, it's probably correlated with crypto values. And it certainly peaked back in February here, I think. And it's crashed since then. It's crashed like 70% in a very short time period. So it shows the volatility.
When did it crash by that amount?
Over the last few weeks, months here.
Really?
Yeah. So it peaked with like one painting being sold for like $69 million, I think. And then it crashed shortly after. And it's trading much lower now. And so generally, it's very comparable to art, right? And in some sense, it's more secure than art, because it's a whole...
You think it's more secure than buying a painting?
Yeah, because there's a digital way of verifying, right? It might be, and that's more secure in my mind. I'm not an art expert, but there's lots of cases of people defrauding or frauding with art.
There's a substantial difference between owning a painting that somebody has made. It's one of a kind, right? You can dispute whether it's an authentic piece or not, sure, and that could potentially compromise the value. But with these NFTs, non-fungible tokens, in relation to digital art, it almost seems rather silly in a sense, right? A lot of people just don't understand where the value is coming from. Because me, as somebody who owns a computer, I could potentially download the artwork onto my own computer, and now I own a version of the artwork. And you could argue, yeah, it's a copy, but what's the difference? They're identical in every conceivable way, except for the fact that you have a token that proves your authenticity of the ownership.
Yeah, I totally agree. That I think it's not something I would ever buy, but I understand the arguments against it. That lots of paintings aren't necessarily these romantic period artworks that are like super detailed, but might be more abstract, or some are more easier to copy. You have a simple style Rothko or something, and it's happened before that people are copying them in ways that even experts that have spent their whole life studying the artist might not see the difference.
But it's not a copy. It's the exact same thing. I mean, it's pixels on the screen. Right? It's the code.
Yeah,
There is no conceivable difference because they literally are the same thing. It's just you don't even need to really own a picture of the artwork that you're buying. You can just buy the token, and that's now you own the artwork without even having it anywhere on your hard drive or anything.
Yeah, I agree. I don't think it's. I wouldn't buy it, and I don't think that it's worth a lot in my mind.
Right.
But I'm simply saying, in the digital sphere of things, you're owning something unique in the token, and I think these people would probably argue that it's more secure way of authenticating than many paintings, and people can copy paintings too. I don't agree with it, but I think that's the argument, and I think that's what drives value. I think it's a total lottery ticket if you buy something, and I think I'm happy that some artists might actually be getting some rich,
Getting a lot of money
from that. But yeah,
can I ask, because this thing seems absurd to me, right? But is there some sort of quantifiable way to kind of calculate whether something has value or not, and calculate how much of value that it has? That would also extend itself to artworks, be that physical or digital, or is it kind of abstract? Is it like that thing we discussed as well, was supply and demand is what it's worth whatever people are willing to pay for it?
yeah, I think especially so in the artwork world, it's supply and demand, right? And artwork is only worth as much as someone is willing to pay, and that's because an artwork isn't a business generating money. You know,
You don't think so?
and the art world might be a business generating money, but no single piece of art that can it's not going to go out to town and work for you, but
Right.
it can increase in value.
Right, exactly.
But that's not the same. You're not buying a huge industrial company that's producing something and earning money. You're never going to get a dividend from your painting.
Right.
And that's what I'm trying to say. So it's based very much on supply and demand. It's also very correlated with stock markets. If people have a lot of money, then they're willing to spend a lot of money on
Right.
paintings. But no, there's no quantifiable way to say how much everything is worth, because it's, especially with art and also so in finance, it's subjective a lot of the
Right.
time. And that's why you have these big bubbles and crashes with a lot of asset classes. That's why it's so important to spread your risk.
But there are certain elements within art as well that kind of determines its value, right? For example, its rarity. Is it one of a kind, or is it one of Andy Warhol's mass-produced works? That's going to compromise the value as well.
For sure.
So rarity, I think price as well. I heard an interview with David Show where he discussed how he'd been selling his works for cheap and nobody wanted to buy it. And then after he said he was not going to sell a work for less than $10,000, that's when he got those high-end clients who were like, oh, other people can't get this. Now I want it because it has this added value of being expensive.
I mean, I think art enthusiasts will say that they can see, it makes a huge difference to them. That's why these artists are famous, because their art is just so much better. And I'm not an art connoisseur, but I would say that there are lots of good artists out there that are probably making just as beautiful paintings, but they don't have the name,
Right.
so it's not getting sold for anything. It's prestige saying I own a Picasso painting. Like, that's wow, It's everyone knows who he is, and it escalates you. It's like having a trophy wife,
Right.
like everyone's like, wow, he's got a hot
Beautiful.
wife. He owns Picassos, or she owns Picassos. Like, that person you elevate yourself to another level in social circles, I believe.
What do you think about buying artwork as a tax write-off? Because a lot of companies do that as well, especially in America, from what I hear. They don't want to pay taxes. They realize that if they buy an artwork that could potentially increase in value through time, that would be a better investment.
Yeah, it's actually an interesting question. So some companies in certain countries have tax credits and tax exempt status for certain artworks. For some companies, they buy lots of expensive artworks, and that's a
Pay
way
no
for
tax as a result of which as well, right?
yeah, so it's a tax efficient way for them to invest. So certain companies invest a lot of money in art, and that's probably also drives prices for sure.
Interesting. I think the artwork is a very interesting topic, specifically from a financial perspective as well, right? In relation to like, because there's a lot of unheard artists who, through the connections, manages to get into maybe an auction house that's very pristine, and they manage to sell their works to high-end clients through that, but who otherwise would have not generated any profit at all through their works.
Yeah, I mean,
There's the famous example as well of Banksy. His artworks get sold for millions of dollars, but in the context of a street salesman selling his artworks $60 a piece, which is something that he did a while ago, they don't sell as well. So it's the name, it's the association with high-end clients as well, and the tax part of it as well plays a part.
Yeah, I mean, in my mind, it's part of the entertainment industry in some way. It's people can be a great artist, but if you don't have a name, then it's hard to get recognized. I think it's an uphill battle. It's like being a great singer. Like there are millions of great singers out there, and I'm sure that there are some that are a lot better than the most famous ones that you know. But the ones that are great at branding themselves, you have some artists that are accused of being, of just trying to generate publicity for themselves by doing these outrageous artworks, and I think that's part of the game in that industry, and it's getting a name, because if it's about prestige and it's not about the beauty of the painting, then prestige comes with the name of the artist, and the more people know the artist's name. If you say it's Bob from down the street,
even if it's a beautiful painting,
yeah, people will just be like, oh wow, that's nice, but they won't know the value, But if everyone knew Bob, I was like Bob's really popular, like that, I know how much that cost, and even if all that Bob had done differently was brand himself, same painting, but now everyone knows Bob, so now there's prestige in Bob's name. Bob's painting gets more expensive.
It also seems like you're a lot of the time paying for the artist as opposed to the artwork. And of course, there are certain artworks that are worth a lot of money because they're recognized, or they're just objectively good artworks in relation to the previous works of that artist. As well, like I think I don't know about the how you pay taxes in China and stuff like that, but there's like people in China seem to be paying a lot of money for artworks as well. My understanding of that is that they potentially do it so they don't have to pay these obscene taxes to the government. They can potentially retain some of their wealth through artworks as well.
Yeah, that might be. I don't know that much about buying art in China, to be honest, but I could imagine.
I'd be surprised if you know. I'd be surprised. I know all about that shit.
I think for sure it's a way of preserving your wealth, and if you live in a country where you might be more afraid of the government coming in and freezing your accounts, then artwork is a portable way of it's harder for the government to freeze your painting. They might come in and take it from you, but it's way easier for them to call your bank and be like,
how much money you got?
Yeah, well, sanctioning your bank and freezing your bank, So in some way, I think I could imagine that in these countries, I see the appeal of the painting.
Right. So I think my final thing that I kind of wanted to discuss with you, which was the thing that we discussed last time, but just to kind of get it documented, was the shorting of stocks. We talked about that in relation to GameStop as well.
Yeah.
That people, tried to short the stocks on that. And I think it was, as you said, it was undervalued. What was the term that you used to kind of, a stock is undervalued in relation to how much it's worth and its revenue, and its. You discussed that before here, earlier.
I can't remember if I said that it was undervalued.
No, you're not in relation to this specific stock, but you said to kind of investing is searching for stocks that have a certain amount of profits and revenues, and then
Yeah, you're trying to determine the fundamental value,
Right,
if it's
exactly.
overpriced or underpriced. Yeah.
So I think you had these retail investors who kind of saw the fundamental value of the company, saw that it was undervalued, and then you had all these basically people on Reddit who bought the stock and then held on to them, and then you had these people who were hoping to short the stock to the point of bankruptcy, who were freaking out and tried to then buy back the stocks as well.
Yeah. So I think the general story is that a lot, shorting is a normal part of the markets, right? A healthy markets, you have people that can say something is too expensive and it should trade at a lower value. That's part of determining, just the allocation of capital. It's an important part of the markets. So most people argue that shorting it should be allowed. It's a simple and healthy part of the process of determining value.
Because you had a lot of these people online, right, who, whether they understood it or not, kind of had this idea of shorting stocks as being a very negative thing and having a very negative association with it, particularly in relation to this incident with GameStop as well, right, where they're basically trying to short the stock into bankruptcy, and that would in turn kind of render tens of thousands of people, potentially more, out of jobs, and all for the sake of profits. But I believe there are examples as well where it's been to the benefit as well, right?
Yeah, I mean, lots of people don't like shorts because it's almost like you're a party pooper. Right. People just want things to rise and everyone earn money on that. And you're right in the specific case of a company. A short, ideally you would want it to decrease totally in value. And in these instances, it's of course sad for the people working for the companies, but I think a short would argue that in a broader sense, it's good for the overall economy, that then these people can work for companies where they generate more value, But sure, lots of people, they dislike them. And I also think shorts have become synonymous with hedge funds and big banking and these big bankers earning big bucks. And people don't like them, right? And they're like, screw the banks, screw these guys. And so you have all these normal people on Reddit getting together. There's lots of conspiracy theories on what happened here. But then they do the short squeeze, right? They because all these hedge funds, they have borrowed the stocks and sold them, and at a certain point, they'll want to buy it back and sell it back or give it back to the investor at a lower price, so that they earn this difference and this decrease in value. But if the stocks all of a sudden start to rise a lot, right, then they're losing money because they need to buy it back at a certain point and give it back to the investor. And so that's what happens is all of these hedge funds are usually borrowed a lot of money to do it, and all of a sudden they need to they have too much risk and they need to buy it back. So all of them start trying to buy back, so the price goes up even more because all these hedge funds are trying to buy it as well, with these Redditors buying it.
So they're trying to generate profits alongside them.
No, they're just trying to cover their position and get out of it.
Right, those are the people who are buying back the stocks.
The hedge funds,
right,
and things like that, yeah. And so it gives an even larger effect, these stocks, they boom in value and these hedge funds might go bust. But yeah, they betted on the fact that the stock was worth too much, that it was structurally challenged, it wouldn't earn the stock price. It was overpriced.
Right.
That's what a short does. So they short it, thinking the value should go down. And these lay people, regular guys and girls, it was like a finger to the system for a lot of people, and it wasn't about making money. It wasn't, I'm sure for some it was, jumping onto the bandwagon. But you saw comments from a lot of these people that
they were trying to destroy the financial elite or something like that.
Yeah, I think it was just about, it wasn't about them earning money. They didn't care, some of these people, if they lost everything.
So it was sending a message.
Yeah, I think so. It's like electing Trump.
Right.
You just throw a grenade and like you don't care that it's not a good choice.
But you don't think that their stance had any form of validity? Did you think it was just like a silly perspective where they should have invested in GameStop and they should have sold when they realized that they could have made the optimal amount of profits, but instead they made this maybe potentially silly choice of sticking with the stock, even knowing that it would probably deteriorate in value through time, just to kind of stick it to the man?
Yeah, I don't think the economic sense was there.
Right.
I don't think lots of people got together and analyzed what it should be worth and said, these guys are wrong, it should be worth way more. I think it was probably a sentimental choice. A lot of people had bought games from GameStop and they liked the company.
Well, I think originally the whole idea behind it was that you could see which stocks were being shorted, right? And they could see that GameStop had been shorted above 100%. So more stocks had been shorted than what was available. And they realized that if they bought up a lot of this stock, eventually these shorters were going to have to buy back the stock that they had shorted and then give it back and hopefully earn the profits on that, right? So their position was, if I buy a whole bulk of this for potentially 50,000, which was one instant. One guy bought a bunch for like 50,000, and then he was like, I'm gonna hold on to this. You guys should do the same. The more of us that do this, the higher the stocks are gonna rise. And that was kind of the idea behind that. And now you can see what percentage the stock is being shorted. You realize that these guys are gonna have to buy it back eventually, and you can generate profits on that.
Yeah, in a lot of countries, it's public knowledge. You have to report short interest. It's called, how many people short the stock, and so usually you can see, what percentage of a stock for a company is being shorted, and it's true. You can see this extreme value for this company, and the more of the stocks of company stock is shorted, the more susceptible it is to the short squeeze. Because the more people will flock, all of a sudden you're destroying their positions and they need to buy it back. So there is a financial sense of, if it was short term, utilizing the short squeeze to sell at the top and earn money. There's financial sense in that, but I don't think that's why most people did it. I don't know for certain, of course, but I think for a lot of people it was more of a statement than a financial long-term investment decision.
Right. There was also the argument of, because you had this, I'm probably going to butcher this, but the argument originally was that you had a lot of these big institutions, right, which through the sheer size of their investments had the ability to kind of dictate where the market would go. But now you have retail investors who kind of group together. They can also have a serious impact on the economy and the price of stocks and all that. What are your views on that? Do you think that potentially these big companies could become obsolete through the retail investors gathering together and basically accumulating their funds into one?
I mean, the retail investors have been a part of the markets basically as long as the markets have been around.
But this is like the first time they've ever had the ability to seriously, affect large corporations.
Yeah, it's the first time they've been able to gather so effectively through these social channels. And I do think that a lot of institutional investors got their eyes open to the fact that investors have a lot of power to move markets in certain instances. I don't think they wrecked the market. No one trusts it anymore.
Right.
And I think in the basic sense, private investors are very much welcome. They're an important part of the marketplace and they help provide liquidity. And I think that that's a lot of people's opinion. That they're not scared of them and they don't want them to go away. But manipulating the markets, doing these pump and dump strategies, that's not good for the markets. And the markets serve a very vital function to society. in capital allocation that is super important, and it's people's jobs, and it's how we distribute goods and services. So I think people manipulating the markets, that's not good for anyone.
Do you think the retail investors did that in this instance?
Yes, I do.
But don't you think the people shorting the stock did that as well?
I do think shorts, they have a tendency to try and manipulate markets and try and spread fake news in some instances, or try and at least make themselves heard. But that's not necessarily manipulating at times. It's, you're allowed to state your opinion, right?
Right.
But if you have lots of investors going together and saying, we're just going to buy, just to screw over another investor group, that's manipulating. If everyone had just gone in, if everyone says, my opinion is this stock is actually worth more, and they buy based on that, that's okay. But if you consciously go in and buy knowing that you're simply doing it to manipulate the price in a certain direction, you don't care about the fundamentals, you're trying to manipulate the price to influence others, that's manipulation.
Do you think that should be regulated?
It is regulated. It's not allowed. You can't just, you're not allowed to spread fake news. You're not allowed to manipulate prices.
But do you think that's what happened in the instance of GameStop?
Yeah, I think that's what happened in the instance of GameStop.
What would be the reprimand for that? What would be the recourse of action to kind of punish these people?
I think some of, I'm not sure how they post always, if you can track them, but I think some of the people that instigated could be liable. I mean, I'm not an expert in.
Because you don't think that they were just expressing their opinions about the stock and they thought it was undervalued, and therefore they thought that other people should potentially invest in it.
Yes.
I mean, surely the people who came later on saw that there was this big hike in the price, and they kind of understood a little bit of what shorting was, and then maybe eventually there became something where people were trying to increase the value of the stock and cheat the stock market in a sense. But originally it might not have been that.
Yeah, and so
and
that's
it's hard to dictate that and regulate that as well, right?
It is. So in this instance, I think you have the records of what people were saying online, and that's what makes the difference if it was in a good faith or in bad faith. The intention is the key for whether it's termed manipulation or whether it's simply a belief that it should be worth more.
You don't believe that in that sense you're trying to regulate morals, that you're trying to regulate whether or not somebody had good or bad intentions in relation to whether or not they should invest in a stock or not?
That's it's a big part of law in general. Your moral behind doing something has a significant influence on whether it's allowed or not. And that's just society. But yeah, if it's in bad faith, if you're trying to do it to harm, then a lot of times it's not allowed. And who am I to say what law should be? But their intention when doing it is the key to whether it was manipulation or in good faith. And if it was simply, we think it's underpriced, it should be worth more. I'm just spreading this out of the kindness of my heart, it should be worth more. Everyone believes me now and everyone buys and it's a happy family. We don't care about the shorts. The shorts are just there. We're not targeting them. We just think it should be worth more. Oh my God, now they're buying too because they're closing their short interest. Oh wow, it goes super high. That's not manipulation. But fuck these shorts, man. I don't know what it's worth, but I bought a game from GameStop when I was a kid and I like it a lot. Everybody, man, fuck the shorts, yo. It's everybody just buy. They're going to have to close their positions. We're going to bankrupt the shorts, man. That's manipulation. It's not allowed. So you see, there's a difference, and the intention makes a difference.
I don't know if they particularly had that view of, I like GameStop when I bought GameStop and shit. I'm sure that had played some part, but I think it was a little more calculated.
A lot of people bought, I'm sure someone thought, I like GameStop.
I like GameStop. It's cool. I think that's a good place to sum it up. I'm pretty sure the camera might have stopped recording as well. The audio's still there though, so that's all good.
Yeah, it's a pleasure to be part of your video
Interview segment or
interview segment. I'm happy to be your guest number 2 on the Joya Show.
The Joya Show. I've come up with a name for it as well. I kind of like that.
What's the name?
The Rough Report.
The Rough Report.
Yeah.
I like it.
Yeah, I do too. It's kind of like a rough portrayal of news and opinions, and just kind of tackling the truth, regardless of whatever, something like that.
I like it.
I like it as well. I'm glad you did so. But yeah.
Well, for the one guy listening in, or if anyone,
It'll just be me.
If anyone ever hears this,
nobody will ever listen to this.
Thank you. Thank you for listening.
I like to imagine one guy just skip right to the end to hear that.
And that's time for a toilet break for Alexander.
Yeah, for sure. Thanks for listening.